The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to have Stan Harley at the break, at the 9:30 break from Harley Stock Market Cycles. And then on the show that I'm going to do 2 hours later, 11 o'clock Eastern Time, I'm going to have Norm Winsky on at 11:30. And so I'll be on both Thursday and Friday with the move into, while Basil is on his vacation. Okay, but that's what we'll be looking at right now, and we'll be able to have everything ready. And we should be okay. Anyway, Stan's a really sharp guy, and it will be a lot of fun having him on, as it always is. We're taking a look here at the DAX index chart, like we always do to start the show. As you can see, we've had a three drive to a top pattern that we mentioned yesterday. We've had the sell-off, and now we're taking a look at this bounce. I'll get to that bounce in a minute, but right now I'd like to switch over to the crude oil market because this is the one that looks very, very interesting for a potential bottom because of what happened yesterday. You know, we rallied about $1.50 a barrel after we came off of that 47.10 level. Actually, I think the low was 47.08 or something like that. And now we're watching to see what's going to happen today with it. But this is one you want to keep an eye on. Folks, if the Federal Reserve is raising interest rates, that is usually inflationary, and that means commodities usually grow up. Now, we're seeing a nice move in gold and silver today, but none of the other commodities, are doing anything at all. So that's just, one particular segment of the market. The grains are still relatively weak, but we do have, some good movement in the meats because of what's happening in Brazil. Brazilian beef evidently is tainted, and so the imports coming from Brazil have affected that market, and it really exploded to the upside. Before we get to the stocks, I just wanted to cover this beef one more time, and just to show you what's happening here, because this is a really good place to realize when pattern recognition doesn't work. If you'll take a look here at the June cattle, we had the June cattle had hit the exact 78% level at 109.50, and from that level you can see on Monday of this week it busted above it, and it just exploded to the upside, which was expected because once it went above that level it only had one other place to go, and that was it. And there was a gap right before that move. That was another thing that was telling us that we were looking at higher prices in the cattle. I know most of you folks, don't trade cattle that much, and we'll, I'm just bringing it up for chart purposes because these charts are the same no matter whether you're looking at cattle or fried frogs or whatever you want to look at. All these charts will be the same. That's just a characteristic of a technical analysis. So we keep this in mind as we go through some of these things. Okay, let's get to the stock market here. We talked about the fact that the S&P stopped right at the 50% retracement down there at the 1132 level. We'll just bring this up here. We'll use the cash, I believe, to let you see where we are here on the cash, because this is what's really happened. The important part of this break, folks, is the fact that we have everybody that's bought since the February 28th presidential address to Congress is now underwater. Everyone, even the NASDAQ people, are underwater. What we're looking for now is a potential three-day rally. Yesterday was the first day of the rally. Today looks like it could be the second day. Maybe we only get one day because we only got one day once before. But anytime we would roll over here now and go below 2330 in the S&P futures, that to me is an extremely bearish situation. just like it was bullish going up, virtually no pullbacks. The same thing is true with virtually no rallies, because all we've been able to do is to rally 15 points, which is, the harmonic number in the S&P is 5.50, so that's 3 times, the harmonic number right at 15. So I don't think we're going to get much above 2350 today. And if we go below 2330 just after one day of rally, that is extremely bearish, and nothing can be more damaging to the bullish side than a market that just starts to cascade to the downside. For one particularly good reason is they haven't seen anything like that in a very, very long time. So the main thing is to keep in mind that that's it. I was joking about the fried frogs, Marshall. We used to, back in Indiana, that was a delicacy for us, because we used to go out in our little rowboats at night with our flashlights to get frogs and make frog legs and stuff. But that's a long time ago. Some restaurants still have frog legs. Haven't seen many of them recently, but those were the old days. Okay, let's move on to the Treasury bonds. Folks, these Treasury bonds are moving higher. We've been up to this 51 level. Let's get this chart up so we can see it quickly here. But we'll watch it here. There we go. Push it up here. As you can see here, we've been up to the 51.05 level. Then we backed off to 150.12, and now we're approaching that 151 level again. That should be some resistance. We're up now 8 days in a row from the bottom that we made, back on the 13th. So that should be some resistance at that point. But, I'm not sure that that's going to be enough to hold it back, because even though rates are going higher long term, short term, this is nothing more than a short covering rally, folks. You can just look at this chart and you can see you've had lower tops and lower bottoms. This is in a downtrend. There's no, denying that just by looking at the chart. That's how you define a trend. If you have lower tops and lower bottoms, you're in a downtrend. Now, if you say, well, what's the yearly look like? Well, even on the yearly, you're on a downtrend. But this one is in a bearish market. The question is, how high can it rally? And sometimes these, short covering rallies can take you to a really unusual place that you didn't think they could go to. So you've got to protect yourself. So if we get above that 151.05 level, the next number would be the 152.11, which would be the 78.6 level. Now, whether it's going to do that today or not, remains to be seen, because it's still early. We're just basically opening right now. The stock should open, looks like about unchanged to a little soft. Well, it looks like they're going to open about unchanged in the stocks today, so it shouldn't be too bad as we watch some of these things. But we'll keep an eye on it. But the other one is, we're going to cover the gold market when we get back from our break, of course, and then hopefully we're going to have Stan Harley on at the break and listen to what he has to say, because he was looking for this market to make some type of a minor top in here from his newsletter, and we'll be watching that. We also need to watch this Japanese yen, because that one is extremely bearish, and we'll take a look at that after the break. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to take a look here at the euro. As you can see, yesterday we went up, actually it was 2 days ago, and we tested it again yesterday too, but we got to the 108.40 level. That was the same level that we had in late January. In fact, I believe it was right around February 1st that we hit that level. Now, I still believe that we've got a potential to move up another 100 or so pips to this 109 to 110 level. This would be equivalent to putting the U.S. dollar index down in the area of 98, 97 and a half is what we're looking for. We've been watching both of those together because the euro, of course, is the exact opposite of the dollar index because it's 53% of the weighting in the dollar index. So that's what we're watching in the euro. Right now we're having just a minor pullback of about 60 or 50 or 60, about 60 pips right now. But it still looks bullish. I still believe we've got a chance to get to the upside. Now, the only thing that would change my mind here is if we went below the 107 level, then I would say potentially that this was a double top at the 50% level. But right now, it still looks like it wants to, go a little bit higher. Now we're going to get to the gold in just a second, but I wanted to show you the relationship that we're seeing here between the Australian dollar and the gold market. This is the Australian dollar versus the U.S. We've bottomed today in the Australian dollar. As you notice over the last several days, even though this has a tremendously high correlation, gold has continued to go higher, whereas the Australian dollar has come down. That's an unusual situation, but the Australian dollar today stopped at the 61% retracement down here at the 76 and change level. And of course, gold has gone higher, has taken out the highs of the last few days, and is now trading in the area of 1252. Silver's still lagging badly, but it's playing catch up a little bit today. So this market's, they still seem like they want to go a little bit higher. So that's my opinion of what I'm looking at. And of course, we know what opinions are like. We've talked about that more than once here. Okay, let's take a quick look here at the dollar index. And where did I put it? There we go again. Well, before I get that, I wanted to mention the fact that Sears Sears Roebuck has come across bad times. In fact, they're alerting their stockholders that they might not be around next year. That's a pretty bad situation. But when I was first trading, this is going back into the 1959, Sears was one of the big stocks to trade along with Montgomery Ward, and those were the two big ones. What happened during the 50s is that Sears made the decision to expand out into the rural areas where the shopping centers were eventually coming. They didn't know that at the time, and Montgomery Ward wanted to stay into the cities. Their CEO was an ex-general named Sewell Avery, who was a very pretty tough dude to work for, but that kept Montgomery Ward under Sears for the rest of the next 60 or 70 years. I don't know. I don't even know if they still have Montgomery Ward stores around anymore, but it looks like Sears is in pretty big trouble here. Another stock that looks like it's in some pretty serious trouble from my perspective of looking at the charts is the president's favorite, and that's Twitter. Look at Twitter over the past year, folks. It's had a range of 14 to 25, and then we're back to 14 again. We just made a 3 drive to a bottom pattern in the Twitter there at the 1.618 expansion. It's due, to rally a little bit, but frankly, the rallies here have been very minor at best. This stock looks like it wants to go to 5, but we'll see. It just looks very bearish compared to the rest of the market. That's for sure. There's something wrong with this stock. Oh, see, Montgomery Ward's is gone, Duffy? I didn't even know that. So I haven't been in a Sears store since Hector was a pup, and he's 17 years old now. And so I haven't been in a Sears. I haven't been in a JCPenney store either. But I don't know if you folks know this or not, but Sears Roebuck, they were about 130 years old. But Mr. Roebuck was actually a black man. He was the genius, the accounting genius behind it. He was a watchmaker from, I believe he's from Hammond, Indiana. And he and Mr. Sears got together, and that's pretty much it. I remember the Sears Tower in Chicago. That thing's 60 years old, I believe, and that was a real surprise to go in that building because it was one big puppy. Goldman Sachs had a big trading operation on the 78th floor that I helped. Not helped design, but I gave some ideas behind it. Tim Broden was the actual designer. He happened to be a good friend of mine that designed those things, and it was really amazing because we wanted to keep the traders away from the windows because it was a tremendous, tremendous views from that area. But that building's really old now. Okay, let's move on and get talking about the gold market because the gold is looking like it wants to move higher from here. We did take out those highs. We haven't taken out the 1265s yet, but that's still amazing. What troubles me about the gold, folks, and I don't have a chart for gold right now, I'll have one a little bit later, is the fact that the platinum and silver are lagging so badly compared to the gold. I mean, they're just, way behind on a percentage basis, and also by looking at, where the Fibonacci numbers are. So that gives me a little bit of trepidation for being, buying gold on a breakout, which you remember I said if we got above that 1240, that's probably a good breakout level, and I think we've never, went back below that level. But, you've got to be watching it really close if you're doing that because buying breakouts can be pretty rough on the old pocketbook because they have a tendency to flip over and go the other way very, very quickly. So that's just my opinion, but, like we always say, we know what opinions are. All right, now let's get back to the stock market for just a little bit. I wanted to show you just what's happened, how the damage has been done here in some of these indices. If we take a look here at the, this is a daily chart now of the IWM, which is the Russell. You'll notice that we rallied up to a 61% retracement the other day. We were only making a 382 retracement in the S&P when this occurred, but look what's happened to the IWM, since that time. We have gone down now, and we have taken out the lows from January in just 2 days. This is not a sign of strength, folks. We're a little bit oversold right now, but this is a really key time from a technical standpoint, because if this is all we get is a two-day rally or a 2-day going sideways, this is extremely big. It's extremely move to the downside. Z is asking when I traded at the Merck. I got there in January of 1982. I traded there from 82, 83, 84, early 84, and then I went to Commodity Corporation in Princeton, New Jersey for 84, 85, and then from there I went out to California, to Pismo Beach, and I stayed there for about 9 years before I came to Tucson, where it is raining cats and dogs today. So we'll be right back with Stan Harley of the Stan Harley Stock Market Letter.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I believe we have Stan Harley of the Harley Stock Market Letter. Stan, are you there?
Larry, good morning, good morning.
Good morning. Gosh, congratulations being named the Timer Digest Timer of the Year for the stock market. That's a real accolade for you, Stan.
Well, thank you.
Yeah. Stan, you were at the old Conti office in Westwood years ago. Isn't that where we first met?
I was in California. I'm not sure I was at that office, But you and I met many years ago when I was president of the market analysts of Southern California, and you
That's right.
invited you to come out and present to our group a few times.
Yes. Now I remember. Yeah.
And then then you and I run into each other at trading conferences on a number of occasions.
Sure. I remember. But it's been over 40 years. Do you realize that? Yeah.
No, I didn't realize that, Larry.
Yeah.
No.
I spoke with Jerome Bressert, Walt's son, on Monday, and we're talking about his dad and stuff. Because one of the reasons I'm here in Tucson is because of Walt. He and Teresa lived here, and I would come over and visit them. And I liked the weather, and they lived out on a little ranchette on the east end of town. And I really liked it very much. So when I had a chance to move to Arizona in '94, Walt had already moved to Mexico, but I still moved there mainly because I would come over here and I enjoyed it very much. So it was a lot of fun. Okay, let's get talking to the markets a little bit. Now, can I just review the folks here? Basically, you're a cycle theorist going back to the days of Jim Hurst and Dewey and all those people, right?
Yes, absolutely, Larry.
Okay. So I've got your first chart up, which is the those are TD means trading days, correct?
Yes, TD is that's my abbreviation for trading days.
Okay, why don't you go ahead and talk to us about this chart, and then maybe we'll have some questions from the folks. So fire away.
Well, just looking at the stock market here, we tend to make what I call intermediate cycle highs and lows about every 33 to 34 weeks. That's roughly 7 to 8 months. There's a dominant turn in the market. And that's been a pretty reliable cycle going back many, many years. It contracts and expands a bit, but the average over the long haul is right around 33, 34 weeks. And in terms of trading days, approximately 160 to maybe 180 trading days, bottom to bottom, on average. And the last occurrence of the bottom in that cycle series was the November 4th low. And we've been chug-a-lugging higher. They call this the Trump rally. The media does, but you and I know it. It's all about cycles. And I think we will again hit a high point in that cycle. I don't think we're there yet. The recent decline notwithstanding, I think we have a few more weeks to go until we get to a high point in that cycle. But in the short term here, we certainly have been pulling back the last couple of weeks. We topped out on March the 1st, and we've been pulling back here. And this is a cyclical function that we see right now. It's kind of part and parcel of that 33 week. It averages 93 trading days, and I've talked about this. I believe you and I talked about this on the air several months ago. It's been a very, very reliable cycle since I saw it. I've been tracking it for years. It goes back to about 2011, and it contracts and expands over time. But the median and the average of this is right at 93 trading days. The last occurrence of this low was the November 4th low, and if you go back 92 days from there, you get the Brexit low. If you go back 94 days from there, you get the February 11th, 2016 low. 93 trading days prior to that was the low we had in late September of 2015, and so on. 91 days prior to that was the May 2015 high. So over the long haul, this thing is averaged right at 93 trading days, and it's due once again right now as you and I speak. So I think we're in a bottoming evolution right here, and I think we're going to stabilize. I have been looking at the daily charts, Larry, of the Dow, the S&P, the New York Composite, and one indicator of trend and support that I think investors should focus on is the 50-day moving average. The Dow and the S&P have not yet tagged that 50-day moving average. They've come pretty close, but they haven't yet. But the New York Composite Index, the NYA, which is the broadest measure of the market, which unfortunately not many folks, including the media, seem to focus enough attention on. But the NYA did pull back and tag the 50-day moving average yesterday, and it's kind of sitting on it right now. So that might be all we get. The cycle analysis says we're right there for a low, and then we just need to see some corroborating technical indications of support. And then I think we're going to be set to push this thing higher once again.
Okay, one of the questions that we're getting from our folks in the den here is, do you make price projections using anything like what Hertz did with the FLD, that future line of demarcation method that he used, or how do you pick your price levels, or that's what they're asking?
I do. I focus. I think it's more important for all of us to focus more on time, what happens on the x-axis, and then what we get on the y-axis is whatever Ms. Market decides to deliver to us. But the answer is yes. I use a combination of things to try to assess some degree of support and resistance. For example, I was just talking about the 50-day moving average. That's a very good indicator of support and resistance. I also use Gann angles. I use horizontal lines that I refer to as octave levels, and I also use Fibonacci, both retracement and expansions. I probably put the Fibonacci as number 3, but I use all of those things in conjunction, and then I look at components if we're talking about the stock market, for example. I look at what I call the Big Five, Larry, and I want to see all components of the Big Five either confirming or non-confirming. For the Big Five for me are the Dow Jones Industrials, the Dow Jones Transports, the S&P 500, the NASDAQ Composite, and the New York Composite. I follow those 5 components very, very closely for evidence of support and resistance or divergences or non-confirmations. And then one more index I follow very, very closely as well is the United Kingdom FTSE 100 index. That index tends to mirror what's happening on this side of the pond, and more often than not, the UK FTSE tends to lead the American market. That is to say, at important intermediate highs and lows, the FTSE tends to either top out or bottom out ahead of our markets. So I would, for example, at an important high, I would see the Dow and the S&P push to a higher high in that 33-week intermediate cycle, but the FTSE may well have topped out a couple, 2 or 3 months prior. And the same thing happens in reverse at bottoms. So it's a complex undertaking, as you and I know, not unsolvable, but it does have some complexity.
Oh, it sure does. Now, the blue line that you have on your chart here showing the 93 trading days. Well, we got to take a break here, Stan. Could you stay with us a little longer?
Absolutely. My pleasure.
Okay, we'll be right back.
If you're looking to unearth a new financial resource and diversify your financial portfolio, consider the new market-safe core commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 4 equally weighted commodities: gold, copper, WTI, oil, and sugar, in one powerful CD. With no pricing caps, you can potentially earn an unlimited upside payment at maturity if the commodities increase in value across semi-annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There's no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. With certain commodities on the rebound, now is the time to take advantage. The March 23rd funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once more, that's 1-855-750-4051 or visit everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
TFNN has put together the finest live programming lineup each trading day, featuring some of the most knowledgeable and respected financial minds in the nation to educate traders and investors. On Mondays, Wednesdays, and Fridays, we broadcast 9 hours a day starting at 8 a.m. as John Logan kicks us off each trading day with the Global Market Pulse. Tuesdays and Thursdays, we broadcast 11 hours. Get an early and healthy start to your day as Nico and Paige bring you Living a Primal Lifestyle. Then catch Andy Hecht at 5 p.m. with the Commodities Hour, following the Tom O'Brien Show. Mondays and Fridays, catch live trading on the Nadex platform with hosts Tom and Tommy O'Brien, along with Daryl Martin on the Bull Bear Binary Option Hour. See the TFNN program lineup via the link on the front page of TFNN.com to get a complete overview of our TFNN shows shows and hosts. And keep TFNN's Tiger TV tuned in on your mobile device, PC, or Mac for the latest financial news and information throughout the broadcasting day. TFNN, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
We're back, folks, and we're talking with Stan Harley of the Harley Stock Market Letter, who happens to be the Timer Digest winner of the 2016 Best Timer. Stan, I posted the chart of your work that you've done with regression analysis, and since this is so far above my pay grade, I just wanted to let the folks see the quality of the type of work that you do. You want to explain to them what this cycle regression analysis is?
Yes, Larry. What I've done here in terms of analyzing the cycle, I do a statistical analysis of the data series, and what I've done is I have in my spreadsheet inserted the dates for all the cyclical terms. And what the regression modeling does, it finds the best fit to the data series. Unfortunately, a lot of people, if they see, for example, a 93-day cycle, they will just arbitrarily add 93 trading days to the last occurrence. Well, that'll get you in the ballpark, but technically that's not the correct thing to do. What one has to do is do a mathematical analysis if you want to do this correctly and find the best fit of the data series mathematically, and that's what regression modeling does. That's what statisticians do. They see a scatter plot of data, and they find either a linear function that finds the best fit, or it might be a curvilinear. In this case, it's linear, and I find the best fit of the data series, and then I also, in the process, compute a standard deviation. And so what that then allows me to do is I can project the next recurrence of the cycle, but the very next words that better be coming out of my mouth are, okay, what's the standard deviation? So in analyzing this cycle over the last 6 years, I can see that the computed length is 92.9, let's call it 93 trading days, and the standard deviation on that is 1.9 trading days. So that tells us we should look to the March 22nd time period for the next occurrence in this cycle, plus or minus about 2 trading days. And that's the very best you and I can do in terms of analysis mathematically. And and then we need to look for validating indications of that. That cycle can expand, it can contract, but from a mathematical perspective, the very, very best you and I can say is this cycle is due once again March 22nd, plus or minus 2 trading days. That's 1 standard deviation. It could expand to 2, it could expand to 3, but there's a 68% likelihood that the cycle is going to occur within 2 trading days of March 22nd.
Okay.
That's a long response to your question, but that's it in a nutshell.
Well, that's a big nutshell, my friend. Now, you're an engineer by trade, as I recall, correct?
I am. My undergraduate degree is in aerospace engineering, and for that reason, I tend to look at these markets like an engineer. I look at the lines on the charts, and years ago, I said, being an engineer, let's see if I can try to model these things mathematically, these up and down recurrences. And and that's what I've done. It's taken me a lifetime, 30-plus years to do this.
Sure.
But that is what I try very, very hard to do, is look at the recurring troughs and crests and try to model them mathematically, and then convey some projection into the future with some modicum amount of tolerance, and then look for the indications. And if I'm looking for a bottom, pounce on it. If I'm looking for a top, pounce on it. And that tends to govern my own approach as an engineer.
Well, Hurst was an engineer. Did you remember Jim Hurst? Yeah.
Yes, Jim Hurst was an engineer, and that guy was a sharp dude. Back in his day, in 1968, I mean, all they had were mainframes, and mainframe time was very expensive. So he fortunately was able to get that time. Now we have PCs that just have phenomenal
telephones. The telephones have.
Yeah, exactly.
Yeah, I don't know if you knew this or not, but Jim Hurst was my customer when I was at Drexel. I had become friends with him over the years, and I had his account. I think he traded maybe once a year, and then he retired up to Grass Valley in Nevada City, up in the Sierra foothills, because he loved to fish.
Right,
yeah, and that's where he stayed. And I visited him there one time, but he was a really nice, quiet guy, and he was just a really sharp fellow. And when I saw your name, I put this all together because, Stan, as I remember, didn't you get laid off as an engineer back in the old '74 recession that we had? Maybe I'm thinking of somebody else, but there were several engineers. Joe DiNapoli was one of them that lost their job during '74 and went into the investment business. I don't know if you were one of those guys or not, but you couldn't get a job as an engineer 1974, '75 in California. I remember that very vividly.
I do remember those times, Larry. No, I wasn't. I was finishing up college about that time at the University of Texas, and I went in the Navy, and I was a Navy pilot for a number of years, right out of school.
Okay.
That was my first life, and then after my Navy flying days, I did some work in aerospace at Northrop Grumman, and then after that, then I got into the financial biz full time.
Okay, I have a question from one of our listeners today, and that is, can you refine this data? You're looking at 93 trading days. Can you go down to a smaller cycle, like 1/5 of that or 1/2 of that, or maybe 18 days or 36 days to find these same cycles on the shorter term time frames?
Well, I do. One technique that I employ for finding cycles, and I have to credit our colleague Walter Brezard for this. He was a big proponent, as you know, Larry, of using D-trend analysis,
yes.
And he wrote about that extensively. He wrote about that in his book, and I've done a lot of work with D-trend analysis as well. And a lot of folks don't know this, but the correct way to plot a moving average is at its midpoint, not at the latest date, but actually at its midpoint. And then if you want to make the process a little easier, you need to choose an odd number. So, for example, if you have a 9-day moving average, the correct way to plot it is 5 days back. So you've got 4 days above, 4 days below, and then you plot right at the midpoint. Okay. And I do that analysis in particular. In my recent report, I showed where I have taken a 19-day, a 29-day, and a 39-day standard moving average, as well as a 9-day, and I subtract the two, and I get an oscillator that moves up and down, and one can see the cycles in the stock market very, very clearly by doing that. And right away, I can see 3 cycles emerge. The baseline, the most common, the median cycle, tends to average about 29 trading days. And then there is a 1.618 and a 0.618 Fibonacci expansion and contraction of that. So we have essentially 3 shorter cycles in the stock market, Larry, of 18 trading days, 29 trading days, and 46.5 trading days. And they are part and parcel of that 93-day cycle series.
Okay, stay with us, Stan. We got a few more minutes, and I want to let the folks know how to reach you. We'll be right back.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we're talking with Stan Harley of the Harley Stock Market Letter. Stan, one of the questions that someone is asking is, do you ever use displaced moving averages, where you take move it 5 days or 8 days out into the future?
I think displaced moving averages do have a place in the toolkit. They do. I don't use them that much per se, but I do think that they have a place in one's toolkit. Displaced for me actually would be to the left on the chart, where I move them back to center them when I'm trying to extract cycles. And the prior question, and I'm not sure I answered as clearly as I should have, that 93-day cycle has a half-span component to it, which averages about 46.5 days, and that shows up quite frequently. And then there is a 0.618 and a 0.382 component of that. But I do know some people will offset moving averages into the future. I haven't found to be that useful, but hey, if it works for others, I tip my hat to them.
Oh, sure. Anything that works is fine with me. Now, the folks that can reach you, what is the best way to, you have a website that they could take a look at?
I do, Larry. It's harleymarketletter.com. Harley, my last name, marketletter.com.
Well, that sounds pretty good, and I really appreciate you being on the show today, and I'd like to have you on almost regularly every couple of months because you certainly have nailed this thing right to the wall, and the work that you do is really, really interesting. It brings back a whole lot of memories, my friend. I can remember the old Cyclotech charts that we used to get and putting all those marks on it and doing all that stuff. Boy, we were back in the days of the Aborigines. You know, there was nothing going on. We used to have to wait to get our charts on Saturday morning from Commodity Perspective by special delivery. We didn't have charts from computers or anything like that. We didn't have computers till 82, 83. So, hey, thanks for joining us, my friend, and travel safe.
Larry, my pleasure. I'm delighted to be your guest.
Hey, thanks a lot, buddy. Bye-bye.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.